Hello, everyone, and good morning. My name is Randy Giveans, head of Maritime Shipping Equity Research at Jefferies. Today I'll be interviewing Charles Maltby, CEO of Epic Gas, as part of the Capital Link Master Series podcast series. Hey, Charles, how are you?
Very good, thanks, Randy. Good morning.
Excellent. Good morning. Yeah, thanks for joining me. Looking forward to our conversation here. So before we talk about the future of the LPG shipping industry, let's first discuss kind of the current state of the small LPG shipping market and how we got here. So spot rates have rallied pretty significantly over the last 2 years, with average rates for your fleet specifically going from $7,400 a day in the third quarter of 2016 to $10,100 a day in the third quarter of 2018. So what caused this rally over the past 2 years?
Yeah, thanks, Randy. Well, we've seen the market gradually recovering on the back of improving supply and demand fundamentals. So in 2014, 15, 16, and early 17, we saw a large number of new builds coming into the sector, which more than offset what was actually quite robust demand growth, which was averaging around about 6% a year on year over the same period of time. But as we came into 17, the number of new builds has eased, and that's obviously then led to a correction in the rates for the market.
Excellent. Makes sense. Now, touching a little more on kind of the upcoming demand drivers for the market. So Epic's ships, very diverse. There was over 700 port calls or so in 3Q18. So what is the geographical and commodity mix for the global LPG trade, and how does this compare with Epic Gas's geographical and commodity mix?
Yeah, so if we look at global LPG production, there's just over 300 million tons a year of global LPG production. And then just over 90 million tons of that, maybe heading towards 100 million tons in the next year or so, is seaborne movement of LPG. And that primarily comes from the primary producing areas for LPG, which is similar to the primary producing areas for oil and natural gas, so North America, the Middle East, and Russia. And also out of refineries where oil is refined, you get LPG as a byproduct there. So we're loading from the primary producing areas and the primary refining areas, and then we're discharging into developing economies all over the world. And that gives us obviously a very wide range of ports. So we've got around about 13% of our fleet in the Americas, 48% in Europe, Middle East, and Africa, and about 40% in Asia. So very widespread. And the number of ports we call is much higher than that of the VLGC sector. Say, for instance, VLGCs maybe have 150 ports globally they can call. We have around about 400. And that's just because of the size of the ports. There's obviously more smaller ports than there are larger ports. But that also gives us some flexibility in where we can trade and an earnings floor, in that we can move our ships from one area to another if there's seasonality or regional demand affecting the rates. Of the volumes we carry, we're moving around about 2 to 3 million tons a year of total product, and about 75% of that is LPG, and 25% of it is petrochemical cargoes, such as propylene.
Okay. And you mentioned there kind of the port size being a restriction for some of the larger vessels. So do you foresee ports possibly increasing their size and maybe dredging for larger ships that could push out some of the smaller ships from the market in the future? Kind of what are your thoughts on port expansion plans globally?
Well, that's constantly happening. And sometimes we're obviously the beneficiaries of that, in that, say, for instance, by the nature of what we're carrying LPG, which usually ends up in bottles of some form at some point, so bottled gas. And that means we're usually going into a developing economy, and that means we're usually going into new or young or small ports. And there's new demand popping up for LPG all over the place. So we do pick up, obviously, new ports for LPG. And then, as you say, the ports expand, they get dredged, and we can grow with them, which is one of the reasons why we have the full range of pressurized LPG ships from 3,000 up to 11,000 cubic meter. So maybe the first few years we're looking at 3,000 or 5,000 cubic meter vessels, and then we move into the 7s, the 9s, and then the 11s. so we can upsize as the ports upsize. And yes, it is then possible that they move into semi-refs or larger, but that does then require a significant investment, not just in the port, but also in the infrastructure on the shore, in that you then move into refrigerated storage and a more sophisticated pipeline and delivery infrastructure on the shore side. And that requires significant investment. So often that doesn't happen. It also depends on the population density of the country in which you're dealing.
Sure. Okay, and then I guess one more demand question, and this one's been pretty well covered in the news recently, but how will the upcoming OPEC production cuts affect the LPG trade in and out of the Middle East?
Yeah, I think it's going to take some time to really flow through. But from our perspective, maintaining a slightly more controlled supply of oil and gas is good, because it helps to balance the price at a slightly higher level, hopefully. And ultimately, we're beneficiaries of increasing supply or investment into new oil and new gas production. So that should hopefully, because the price is higher, lead to increased long-term production of gas and oil, and that will lead to increased demand for our vessels. But in the Middle East in particular, we're not, as Epic Gas, particularly involved in the large markets for large volume LPG out of, say, Qatar. That's not the typical trade for us. We're more involved in the niche trades out of, say, Iraq. And that volume we don't anticipate reducing. So for us, it's all fine.
Sure. All right, well, yeah, seems like demand is pretty stable and growing, but now switching gears over to LPG shipping supply. So after fleet growth in 9% in 2015, another 6% in 2017, another 4% in 2017, the small pressurized LPG order book is now down to only about 3% of the fleet. So with that, almost 10% of the small-size LPG fleet is over 25 years of age. Pretty good candidates for scrapping there. So with that, two questions. First, why do you think the order book has gotten this low, down to 3% of the overall fleet? And what has caused the lack of new building ordering recently? Do you think it will stay below this 5% in the coming years?
Yeah, so why are we down to such a low level? I think there's been a lot of new builds in the last few years, and we've seen a large growth, and the entire sector has realized that the consequence of that were lower rates in the sector. And indeed, we've had rates in 2016 coming into 17 where we were at 15-year lows. So that's led to an element of caution when placing further new build orders. And that 3% is obviously 1% a year. It's not 3% in 1 year. It's 1% a year for the next few years. And then we also look at the yard capacity. So the primary building country for pressurized LPG is Japan, and the Japanese yards, they do have a choice over what they build. They can build pressurized LPG ships, or they can build chemical tankers, product tankers, reefer vessels, and so on. And so they've seen different demand curves for different types of ships, and that's tempted them into building different vessels, which is good news from our point of view. And then the pricing has also not been the sharpest in the last couple of years due to the yen-dollar exchange rate and due to the increasing pressures on the costs that go into building new ships, whether that's the steel price, which comes out of the iron ore price, which have been higher, or new engine designs, or meeting IMO requirements for Tier 3 vessel designs, which are also now coming into legal force. So that's changing the cost element of the ships that we're seeing out of Japan. So it's not the cheapest pricing right now, and that puts us off rushing to, and when I say us, that's the sector, from rushing to build more vessels.
Makes sense. And with such a small order book and a lot of those older vessels still operating out there, what are your fleet growth expectations for maybe 2019? Could the fleet possibly contract?
Absolutely. There's been some fairly steady scrapping over the last 3 to 4 years, And if anything, it's been picking up as the rates have recovered. And I think there shouldn't, it's the wrong correlation to say rates are going up, so more ships are getting scrapped. It's also an illogical correlation. I think if you look at the legacy of when the fleet was built, it's a relatively young fleet, or a relatively young sector, let's call it, in that pressurized LPG as a sector only existed in a very small way back in the 1980s and the early 1990s. And there was a significant build-out of tonnage as you went through the 1990s. And it's now those ships that are coming into the 25 to 30 years of age. And that's leading to a larger pool of vessels that could be scrapped and actually is being scrapped now. And then at the same time, we've got the semi-ref sector, the smaller vessel semi-ref sector, which is also aging as quickly as the pressurized fleet. And when those vessels are scrapped, there are no new builds to replace them. So the pressurized fleet is also gaining incremental demand growth from the scrapping of the small semi-ref sector. So we think it's quite plausible that there'll be net negative fleet growth this year, next year, and maybe the year after.
That's right. Okay. Now back to Epic Gas and your fleet specifically. You mentioned obviously Epic Gas focuses solely on the smaller, fully pressurized market with a fleet of 38 fully pressurized LPG carriers. Now 32 are owned and 6 are time chartered in. So how do you decide between that balance of buying vessels versus chartering in vessels?
I think the primary driver has to be cost. So you have to look at what is the cost of a new build right now, a second-hand vessel right now, and then the cost of how you finance that vessel. And do you choose to finance it through a traditional debt equity structure, or do you look at the more modern sort of sale and leaseback structure or chartered relationship? Whichever gives us access to a vessel long-term at the lowest price possible. It's also important, though, to have an element of control over the fleet. And in order to have control, it is useful to own a percentage of your fleet, I think. It gives you better access to the financing banks and so on as well. But for us, we look at it very much on a case of what's the most cost-effective way of controlling high-quality tonnage for the long term. And it just comes down to the cost that of a time charter ship versus a bareboat ship versus a straightforward owned vessel.
Okay. Kind of segue on that controlling of your fleet. You seem to be focused on the 7,000 to 11,000 cubic meter segment, and with roughly 30% of the market share. So, kind of why is this, and should we expect future Epic growth to come in that segment?
I think what's most important for a shipping company is that you have really solid long-term control of high-quality, safe, young vessels. And that then gives you 2 to 3 market cycles, maybe more, in order to run that fleet, maximize the earnings, minimize the costs, and then also to time your exit on the asset as it gets towards being a few years older. So that's partly what's driven our investment into the larger vessels, because we wish to future-proof our investments, and that we recognize that all shipping sectors gradually upsize in time. What was a handy-sized bulk carrier in the turn of the century was 28,000 deadweight, and it's now 38 to 40,000 deadweight, and it's the same for pressurized LPG. What was a sort of normal-sized vessel at the turn of the century would have been a 3.5 to 5,000 cube, and we're now ready with the 7 to the 11,000 cubes as the market upsizes. But also it's around the OPEC, in that a typical average OPEX for our vessel is about $4,000 a day, and it doesn't matter whether it's a 3,000 cube or an 11,000 cube. There's only about a 10% margin on that, whereas obviously the revenues can vary considerably. Revenues for an 11,000 cube can be as high in the spot market as, say, $20,000 a day, whereas for a 3,000 cube, it's more like $8,000, $9,000, $10,000 a day.
Okay, got it. Well, now let's take a step back and look at the global economic picture. With fears on Wall Street of a looming recession or economic downturn around the corner, how much do macro factors affect your fleet and cash flow generation? Is Epic Gas concerned about a downturn in the near or medium term, or is Epic semi-insulated, let's say, due to its time charters?
I think, personally, LPG is one of the environmental fuels of the future. So we feel that by investing in tonnage to move that commodity, we're investing in a commodity that can thrive through any macroeconomic picture in its underlying long-term demand. So that's part of why we're invested into LPG. Secondly, it's really important that we focus on building a business that can thrive in any market circumstance. So, for instance, should there be a negative market correction because of the macro picture, then we should be using that to invest into tonnage and growing the business on the asset side, which is what we've been doing effectively in the last 3 to 4 years, is using the lower market to build cheaper vessels and to grow our fleet with assets at bottom of market pricing. And the same opportunity could arise if the market moves down again. But it's also, of course, useful to have higher market times in order to generate cash for the future.
Sure. Well, yeah, speaking of cash, putting all this together, investors want you to show them the money, right? So Epic has earned over $9,000 a day over the last 12 months. So how does this compare to your average OPEX or break-even rate? And lastly, kind of what are your base case and best case scenarios for average day rates in 2019? And what would those rates equate to on an EBITDA basis? So kind of break-even levels, expectations for day rates, and then EBITDA for 2019.
Yep. So the focus is very much on us to prove our business model, I think, at this point. That's where the pressure is on us. Historically, the business of Epic Gas, we're a young business, and so we haven't had the benefit of history to show what we can do in a good or improving or better or even high case market. So it's difficult for investors to judge us, and that's part of the learning experience we're all going through, is being able to say, well, look, in a bad market, this is what happens in an average market. This is what happens in a good market. Isn't it fantastic? So we're in that stage now of moving from a bad market to a good market to a fantastic market. And yes, our average OPEX is about $4,000 a day. Our average SG&A is about $1,000 a day. So our earnings of $9,000 is clearly showing that we've got some margin above our base costs. And we would expect that the rates can continue to move up. The EBITDA we earned in Q3 this year was just under $14 million, which was over double what we earned in 2017. So you can see that we've got potential to push the EBITDA up to the mid-50s, even $60 million if the market stays at today's levels, as compared to our 2017 full-year EBITDA of just under $30 million. So it's almost a doubling year on year.
Wow. All right. Good trajectory for sure. So I guess in conclusion, kind of wrapping up, I'd like to give you the opportunity to talk about the competitive advantages of Epic Gas. So how do you differ from other LPG shippers such as Dorian or Navigator or Stealth Gas? And then is the market missing something maybe about your company, or do you feel that Wall Street and investors understand your story and have gotten it right?
Yeah, I think this is touching also on what I was mentioning in a few seconds ago. The focus is really on us to prove that our business model is working now, and we've used the last 4 to 5 years to grow our business and to deliver a platform and to deliver scale, where we now have 15% market share of the pressurized LPG sector, and we've also built a business with an average fleet size that is larger than historical comparisons that can be made. So we're driving a different business into a stronger market ahead of us. When it comes to benchmarking, for instance, we're very customer-focused in how we do business. We don't mind whether we do time charter, voyage charter, COA, single fixture, floating rate, fixed rate, index rate with our customers. What's most important for us is that we understand what the customer needs, and we work with them for the long term to deliver a growing business for them, which hopefully benefits us with a growing business as well. And I think that's one of the biggest differentiating factors we have, is getting out and sitting down with customers and really understanding their business and helping them to grow.
Sure. And then kind of lastly, what are your thoughts around consolidation in the sector?
consolidation in any shipping sector, I think, is good. The pressures are really on any ship owner right now to minimize costs, maximize their investment into digital, IT, environmental, technological improvements, whether that's ballast water treatment systems, scrubbers, low sulfur fuel, tier 3 designs, and so on. And it's very difficult if you're a small ship owner to make the maths add up. So the more consolidation, the better. And that then enables us to then roll out on the customer side and deliver a global business with high-quality ships for a customer anywhere in the world at a good to low cost.
Sure. Makes perfect sense. All right, well, hey, thanks again for joining me today, Charles. Really enjoyed discussing the LPG shipping market as well as kind of the strategic position of EPIC Gas.
Thanks very much, Randy, for the questions. Really appreciate the chance to discuss the business.
Absolutely, yeah. And thanks to all who joined us for today's Capital Link Master Series podcast. If you have any questions about the shipping markets, feel free to reach out to me at rgivens@jefferies.com. Have a blessed day.